There it goes. 0 DTEs throughout the day.
Very nice. Let's get into it. 0 DTE options in the right underlying are fast, liquid, and highly accessible to retail traders. Very fun to trade, instant pain or instant gains. The extreme speed of the 0-day marketplace can easily leave traders feeling like they missed their chance at a choice opportunity. How have 0-day short premium trades placed later in the day performed, and are there reasons to prefer certain strikes at certain times? What are you thinking?
Watch your size in there.
Yes.
Don't do like I did.
Yes. All right, getting on to the next slide. Let's look at the study. So we're using 20 months of data in SPX. We're doing the 0 days, of course, collected every 10 minutes. Examine selling 0-day strangles using 20, 30, 40, and 50 delta strangles, and 50 is a straddle. Strikes at the market open. So we're looking at 10 a.m. Or we're looking at the market open, 10 a.m., noon, or 1:30. All trades were managed if they reached 25% of the max profit. Losers and those that didn't reach 25% were allowed to expire. Of course, SPX cash settled, so this is no big deal. Everything that settles to cash at the end of the close. All trades were assumed to exercise at mid-price, and the cost of the buying power controlling long strikes was neglected. Subtract 10 to 15% from daily P&L. Subtract $10 to $15 from daily P&L for more realistic results. Okay, so we're talking about, the spreads on the close, because sometimes these spreads widen out, and this is also the problem with a lot of back tests in general. Is that you have these widening out spreads on the close, and SPX ticks for a couple minutes as well throughout the close. So saying $10 to $15 is how you can discount that.
Yep.
All right, so looking at it here, we're looking at the open straddles, 40 delta strangles, 30 delta strangles, 20 delta strangles will give you the win percentage, the win rate on those, average P&L, and then the CVAR, which is our covariance of risk. Jump into the next slide here. So we're looking at 10
And also these are strangles. I didn't have as many strangles on because it uses way too much buying power.
Yes.
I was buying wings, and I was like $30 wide, $20 wide, $40 wide. So a little bit different there too.
So looking at 10 a.m., this is what we got for the win percentages for all those above the average P&Ls. You can see the 40 delta strangles are obviously going to be the highest P&L. It also has, your highest CVAR as well, because, you're right at the money there too. Same with the straddles there, but pretty much the same thing. I mean, you're seeing the 40 delta strangle actually increase profit potential from versus the open, which is kind of interesting. I guess you get, a little bit of the back and forth price action, maybe a change in volatility.
Sure.
That kind of helps you in that first hour or so.
Sure.
Better prices too, probably better bid-ask spreads.
Sure. I'm going to actually challenge the team to take a look at this maybe next time Tom is out again, which could be never. But let's maybe when he goes on one of his trips to parts unknown.
Foliage week or
something like that.
That's the next one.
Maybe looking at buying the 20-ish delta option, or buying the 15-ish delta option, or buying the option that gets bold. That gets to $2 on either side at the at some period of time, and seeing how that performs. I think we need to present both sides, because 0 day is really all about direction, whether it be no direction.
Yeah.
I think we're going to revert back to the mean if you're playing buying the dip or selling the rip kind of thing, or we're going to continue on. It really is a lot about direction. And I think basically what this is saying right now, at least over the last 20 months, you haven't had a lot of directional movement over time, and the short premium strategies have been working at the beginning of the day. But go ahead.
Getting on to the next one. So looking at noon, you could see, again, the 40 delta strangles kind of staying at the highest average P&L, of course, the highest risk as well. And you're going to have this trade-off in any trade you do.
Yeah.
You're always going to have higher potential wins with more premium, with higher premium positions, specifically those higher delta options, but you're going to typically have more risk as well.
Sure.
So same thing here. And then you
want the numbers play out across the board too, they've
all been good. They've all worked out.
Yeah.
from an average P&L standpoint. I think this is the more interesting one. The last slide, or the second to last slide here, looking at 1:30, which is, kind of the time, I think, where things start to move a little bit. You throughout the day, that the first hour and the last hour of the day are the most liquid parts of the day. And there's many market dynamics that go into that, from rebalancing of funds and liquidating of positions at the close that you don't want to take overnight. I mean, those are market dynamics that lead to more liquidity at those points, which is interesting to see. This, being both the least profitable from your average P&L standpoint, but the at the money straddles now
They flip.
They don't work. And I think that's because of just the natural sort of, for lack of better words, tail risk that you have in the last hour or so of trading, where, things can move real quickly. And you're kind of seeing it here, those bigger meteor options, the 40 delta and the straddles, are seeing a much higher risk and much lower, average.
Yeah, the CVAR is
profit.
basically staying the same across the board here on the whole thing. And you're right. And the 20 delta strangle where I was living was the wrong place to be.
Yeah.
From my own. And you're right. I mean, it goes back to that 30, 40 delta. I think I'm closer to the 30 delta because I was closer to the 20 delta to begin with. So I think the 30 delta is where I go. Higher pop, give up a little bit of the P&L profit. But I learned something today. I knew that straddles would be tough, but go ahead.
That's actually a good point. The CVAR kind of stays consistent throughout, because we get that question all the time. Like, should I do this trade at the open, or wait 10 minutes, or wait 1 hour, or wait, until noon, or do it, 10 minutes before the close? From a risk perspective, they're all kind of the same. I mean, you have that tail risk. That is certainly there, and you're going to eat that at some point. That's going to happen. But from a strategy perspective, you'll be able to pick your risk and reward based on what we presented here.
Yep.
Good stuff.
Good. Next one, please.
Takeaways. Overall, the past 20 months have been a good time for selling zero-day premium, using consistent initial deltas, i.e. adjusting strikes for implied volatility, and remaining time until expiration gave very similar results, as long as there were still a few hours left in the trade. Not that this meant bringing strikes closer to at the money as the day goes on. Note that this meant bringing strikes closer to at the money as the day goes on. This is another important part that we didn't even touch on with the 40 deltas. They're all the deltas.
You're right at the money, basically.
You're right at the money, so your strike selection is much, much different.
Mm-hmm.
By centering our mechanics on initial deltas and using percentage of profit targets, we can adjust our trading seamlessly regardless of when we place the trades and what the volatility environment is. Been a good trade over the last 20 months. I like it.
Who knows if we're going to continue, but all we can give you is the past.
Lots of people on Twitter trading them.
Yes.
Iron condors, strangles, straddles.
Yep. I see them. I watch you.
Johnny, my guy Johnny on there.
Yep.